It's true. We spent the last 6 months on this channel revealing all of the ways we can help you save on taxes and claim every deduction and credit possible. And now I want to help you avoid an IRS audit. Although your chances of being audited in general are pretty low, there are certain red flags that increase your odds dramatically, and the IRS loves catching them. Note that this video is for educational purposes, and you should contact your attorney or legal professional for specific advice for your situation. Okay, let's dive in. Welcome back to the channel. I'm Quran from Life Accounting, where we help you increase profit and lower taxes. And the first red flag on our list, not reporting taxable income. You see, failing to report taxable income is likely the most common red flag there is. It is also one that is easy for the IRS to catch. When you earn income from another business, you typically receive either a W-2 or a 1099 documenting that income. But you're not alone, because the IRS also receives a W-2 or a 1099 documenting the income you received. And for this very reason, any mismatch between the income you report on your return and the income shown via your 1099s or W-2s will raise a red flag. And to avoid any issues, report all income you receive, no matter how small the amount. And really think about it, because this can include some things you don't think of, like credit card cash back rewards or even dividend income. Heck, even a recent referral fee I received from an apartment complex came with a 1099. All right, let's move on to the next audit red flag, deducting losses from a hobby. Every business isn't going to be profitable from the start, but if you report multi-year losses from a business the IRS deems a hobby, you will raise a red flag, especially if you also receive large amounts of income from other sources. According to the IRS, to deduct losses, your business must operate like a business and expect to make a profit. But what does that really mean? Well, here's a general guideline for you. If a business reports a net profit in 3 out of 5 years, the IRS assumes that it is a business that expects to make profit. On the off chance that a business reports an overall loss in more than 2 out of the 5 years, the IRS assumes the business is a hobby. That's pretty harsh, right? Well, here's some good news. Say you don't meet the 3 out of 5 qualification. Other factors may help your case in classifying what you do as a business, such as large amounts of time put into the business and also reasonable startup expenses for your type of business. Next up on our list, claiming 100% business use of your car. Look, being able to deduct the business use of your car can turn out to be one of the largest tax deductions you can use to reduce your income. But the caveat to the deduction is that you can only deduct a percentage of expenses or mileage that apply to the business use of your vehicle. Therefore, if you only use your car for business 40% of the time, you can only deduct 40% of the expenses or mileage. So when someone claims 100% use of a vehicle on their taxes, IRS sharks start circling. And this is especially true for those who don't own a second vehicle, as it would be pretty hard to believe you only use your vehicle for business use. To stay on the safe side of the IRS, be sure to keep detailed records of miles driven and calendar entries for dates the car was put into use. By the way, if you haven't already, go ahead and like this video for me. It helps the channel out a ton with the YouTube algorithm, and I would greatly appreciate it. All right, back to the video. Here's the next big IRS audit red flag, having a large income. The truth is that your likelihood of an audit significantly increases as your income grows. More money, more problems. But don't take my word for it. If we take a closer look at the About section of the IRS website, we can find an article from the IRS with the title, IRS Audit Rates Significantly Increase as Income Rises. No, you heard that right. An article in the About section of the IRS website has an article with the title, IRS Audit Rates Significantly Increase as Income Rises. Let's take a look at some data to back this up. In 2019, the IRS audited 0.4% of all individual tax returns. For those with incomes between $200,000 and $1 million, that audit percentage more than doubled to 1%. And 2.4% of people with income over $1 million were audited. So, judging by the numbers alone, it's clear that returns reporting higher income are looked at a bit more closely by the IRS, as the ability to benefit from large deductions and credit increases as your income increases. Next on our list, overstating deductions and credits. According to the IRS, audits are triggered via computer by what they call a discriminant function test, or DIF test. The discriminant function test compares the deductions and credits you reported to similar returns and then rates your return for the potential of unreported income. Basically, the IRS has a gauge for how many deductions and credits are typically taken at every income level. And if the deductions and credits you report don't seem normal, your return will be flagged and reviewed manually. But with all that being said, don't be shy about taking every single deduction and credit you deserve. My only recommendation is to keep good records to back them up. Next IRS audit red flag is claiming large losses from gambling. My favorite form of gambling is poker, but one thing I wouldn't gamble with is the IRS. No? I should stop? Okay. Jokes aside, the IRS pays heavy attention from losses claimed from gambling. This is because you can only deduct gambling losses to the extent that you report your winnings. So if you gamble recreationally and claim losses, the IRS will be looking to see if you also reported your winnings in your income. If you claim you gamble professionally, the IRS is looking to confirm you actually gamble for a living. And if you gamble at all, be sure to report all income you receive from winning, as many casinos report your winnings to the IRS. This next one is a big one: failing to report stocks and cryptocurrency gains. When you sell a security or stock for a gain, two things likely happen. First, you jump for joy. Secondly, you owe taxes. Now, how much you owe in taxes will depend on whether you held for more than a year before you sold, and if you had any losses to offset your gains. In any case, most taxpayers must report the gain on Schedule D of their tax return, and failure to do so will automatically cause suspicion and red flags to rise. Luckily, these days, most brokerages send you a tax form that outlines your losses and your gains, making it easy for you to report. In the instance you file your taxes and forget to report your gains, you should amend that return and then refile. Last on our list, performing cash transactions. Dave Ramsey isn't gonna like this one, but performing cash transactions can raise an IRS red flag. That's right, you might not have known this, but any business or trade that receives cash transactions over $10,000 must report that transaction to the IRS via Form 8300. In addition, financial institutions report on suspicious activities and attempts to avoid transaction rules to the IRS. This level of scrutiny is a result of the IRS attempting to crack down on money laundering. And if you deal in large cash transactions, whether via your business or in your personal life, be sure to keep good records of the source of your income. Well, YouTube family, there you have it. 8 IRS audit red flags you should be aware of. I hope you found this video useful and interesting. If you did, please go ahead and like this video and then comment below if I did a good job of explaining. Also, don't forget to subscribe to our channel so you don't miss out on other videos we're putting out to help you lower your tax liability. I'm Karan from Life Accounting. Until next time.